Hi, I'm Jimmy. In this video, we're looking at the VF Corp, ticker symbol VFC. This video is part of our Dividend Aristocrat series, where we're analyzing each of the companies within the Dividend Aristocrats ETF. The goal of this series is to see if we can find the top Dividend Aristocrat stock that ultimately have a good chance of paying us a reliable dividend and ideally getting us closer to our personal goal of financial freedom. Okay, so first I'm going to dive into VF Corp's business, and then we're going to see if we can come up with a fair value for VF Corp's stock using a discounted cash flow valuation technique. Okay, so let's dive into their business. So we could break their business into four main categories. First up, we have their active segment, which accounted for about 34% of revenue from last year. Their active segment includes brands like Vans or JanSport. They sell luggage, they sell backpacks and active footwear, things along those lines. Then we have the outdoor segment, which is about the same size as the active segment. They have brands like Timberland and the North Face. They primarily focus on products like footwear and outdoor apparel. Then they have their jeans segment. This segment includes brands like Wrangler or Lee. And as we might guess, well, they sell mostly casual denim products. Okay, simple enough. Then their smallest segment is their work segment. This segment has brands like Dickies. This segment focuses on apparel and footwear that most of us would wear to work. Now, VFC actually does a good job of breaking down their business in different ways, making it a little easier for us to analyze. Another way they break down their business is by region. And as we could see, the Americas brought in the most revenue last year, followed by Europe and then the Asia Pacific region. Now, I bring this out because the management team of VFC have said that one of their goals, or one of the four key drivers to their long-term success, is the growth of the Asia Pacific business line, especially or specifically in China. They believe that this should help spur additional growth for the company and is one of the real opportunities for their business. And if we're curious, according to management, their four primary drivers of growth are expected to be their expansion in Asia, that's the one I already mentioned. Then they're looking to invest in their own brands to help improve their performance. Then they're trying to improve their performance with their customers, their consumer experience. Now that's true on both the retail side, but also with their direct-to-consumer portion of their business, which is their final point. They believe that there's a big growth opportunity in their direct-to-consumer business, which has been growing fairly well in the past few years. Okay, now this brings us to their revenue. And as we can see, even with analyst projections of revenues, analyst projections are the one in the green bars, well, revenue's been somewhat stagnant. Now, we may notice one interesting part to this is that we seem to have skipped over 2018. And this actually took me a bit of reading to sort out. And for that, I think the easiest way to explain what happened there is to switch over to a quarterly chart. Now, what's most important for us to notice with this is that although it seems that we skipped over most of 2018, well, if we switch from quarters to the actual day that these quarters end, well, we can see that they did not, in fact, skip any time periods at all. What happened was this company, VFC, switched the end of year quarter for them. It used to end in December of every year. Now they moved it for some crazy reason over to March. So as an example, in 2017, those were the four quarters that made up the full year. Well, in 2018, these four quarters made up the full year. And to make it even more confusing, since these four quarters ended in 2019, they now call this the fiscal year 2019. And essentially, they started calling this one quarter here a transition period. So even when we pull down Yahoo Finance, just as an example, well, we may, even though we're looking at annual numbers, and here's the annual number indicator, even though we're looking at annual numbers, well, we may think that they might have had a really bad 2018 when we look at this huge drop in revenue. Okay, so although they don't really explain this that much, I just want to point that out because I thought that was an unusual thing to sort through. Okay, now we know what happened. Now let's see if we can value VFC stock using our discounted cash flow valuation method. Okay, so here's what I came up with for the VF Corporation as far as DCF. I'm not going to spend too much time with how I did this calculation. I actually did a much longer video on how to do this whole process. There's a link in the description below if you're curious. I even created an Excel template that you're welcome to have. Link in the description below. But basically, I took these estimates up here. I took these from analysts. Now, the fact that they changed when their year end is somewhat irrelevant for this particular valuation technique since we are projecting out the next 4 years. So the fact that they're ending in March now and not December really doesn't matter to this valuation method. So I took analyst estimates here, and then I discounted them by a required rate of return of 8.5%. That's what I've been using for all the companies so far in this series, just to keep it consistent. Same is true for our perpetual growth rate of 2.5%. Well, that gives us a fair value of the company of a bit over $25 billion. We divide that by the shares outstanding. They get about 399 million shares outstanding as of the recording of this video. That gives us a fair value for the company of about $64 per share. And when we consider that VCF is currently trading at about $83 per share, well, it would seem that our fair value implies that the stock is currently overpriced. So clearly, that's a negative thing. Now, on the positive side, one of the main reasons we're looking at this company is that VCF is part of the Dividend Aristocrats ETF, which means that we might expect for their dividend history to look something like this, and clearly it does look quite good. And then when we add earnings per share, well, once again, they look fairly decent. Earnings per share have consistently covered their dividend per share, which is exactly what we want to see. Now, when we look at this, well, for me, the positive side of this is their dividend history. And that, in theory, although I like their business, I think that they have a solid business. I think they bring a lot to the table over the long run. I think it makes much more sense to wait to buy this stock at a much better price, even though their stock price has fallen a significant amount recently. I still think it makes more sense to buy it closer to our calculation of fair value. Whatever your calculation of the fair value is, I would stick with that. Now, if you're curious about when the best time to buy a stock is, I actually did a video on how to come up with that using your own analysis. There's a link right here, and there's a link in the description below if you're curious. That could be a good next video to watch. And I want to thank you for sticking with me all the way into the video. I really appreciate it. I hope you found it interesting. Thanks, and I'll see you in the next video.